All right, take it away.
Okay. Good morning. We're on to our next financial session in our financial literacy series. Today we're going to be talking about predatory lending. And thank you to Virginia Cooperative Extension and Military Family Learning Network for supplements to these materials. Again, I'm Mary Crawley. I have experience in teaching, education, and counseling, and I'm currently assisting financial members or service members, military service members in financial crisis. Okay, so today we're going to talk about what is predatory lending, who do these lenders target, red flags that this is a type of predatory lending, different types of predatory loans, and ways to avoid falling in that predator's trap. So by definition from the Truth in Lending Act, predatory lending is extending credit to a consumer when based on their situation it's unlikely they would be able to repay that debt as the terms of the debt are given. So characteristics of predatory loans, they're going to have high interest loans, lots of fees associated with them. The salespeople may be specially trained to put pressure on the customers to sign up for these loans. The repayment terms are generally not affordable to that family. They might involve harassing collection tactics and threatening collection tactics, deceptive advertising. They prey on consumers' lack of information or lack of confidence in financial institutions, and they abuse lending and credit practices. So who do they target? Vulnerable populations. That might be the elderly, people who are young and don't have a lot of experience managing finances, people who don't have much savings and are living paycheck to paycheck, people with weak credit records, poor credit records, not much experience with credit records, people who are living beyond their means or have limited education. So, this is a problem because it's a big threat to low-income families, and it wreaks havoc on a borrower's finances because it's very difficult to get out from under these. It can be very difficult to get out from under these types of loans. It can make it difficult to get reasonable terms in the future, and they'll frequently will grant credit and money even if the borrower has little ability to pay it back in the future. Actually, that's a lot of times what they want. That's how they make their money, is having to roll over these loans. So, these are lots of different types of predatory lending. They involve payday loans, refund anticipation loans with your taxes, car title loans, overdraft loans, check or credit or cash or check advance loans, rent-to-own contracts, pawn shop loans, credit repair companies. So we'll go through a bunch of these different types of loans. So payday loans. What the borrower does is they're borrowing against their next paycheck. They write a post-dated personal check to the lender, which in the amount in the loan amount plus all of the interest and fees that are wrapped up in the loan. The fees can be a percentage of the check amount. So let's say that you borrow $100, there might be a $20 loan fee with that amount borrowed. A lot of times they last about 2 weeks and the check is not cashed for 14 days or a certain period of time. So a typical charge is $15 to $20 fee per $100 of the loan. So you might have to write a check for $115 to borrow $100. And the $15 finance charge might not sound too bad, but for a 2-week period, that translates into a 390% APR, which, considering that credit cards with high interest rates you might think of as being 25 or 30%, we're talking way, way higher than what a bad interest rate on a credit card is. And I'm going through this, although we in Virginia actually have fairly good protections on payday loans and regulation. Some states have no regulation whatsoever. So we're covering this depending on where you're watching this from. Some of this might apply, or we in the room might have relatives in other states that could be affected by these specific rules. We're kind of going through the worst case example with what happens to some families. In Virginia, it is now legislated you cannot roll over payday loans. That's not the case in all states. So in some states, when it's that payday and for the date that the check is written, you either the lender deposits it if you're ready and you've paid off your loan, your $100 plus your $15 charges, or if you don't have that money, they roll it into a new loan with a new fee. And that's where they really make their money. So let's say that someone has to roll over 3 times before they have the money to pay it off. They've borrowed $100 and spent $60 in fees to borrow that $100. It can get even worse. If you have to roll it over for six times, if it's a 2-week loan, that would be 3 months of rolling it over. Your finance charge of $105 now exceeds the amount of money that you borrowed. And that can happen. As an example, there was a hospital cafeteria worker who earned $16,000 a year. She needed $200 to pay her bills, $200. There was a fee of $16 per $100, so she paid $38 to borrow the $200. Unfortunately, she couldn't pay it at the next payday, so they rolled it over. Kept rolling it over because she didn't have the principal to pay it off, kept paying the $38 to roll it over. After a year, she paid over $1,000 in fees and still owed the $200. So these things in some states are really bad. So unfortunately, they state usury laws that protect you against high interest rates. When the lenders call them fees and regard them as fees, that has kind of a loophole around the laws that prevent charging exorbitant interest rates. So the loan, even though this loan cost in the long run is really in the long run just like an interest charge. So the small fees can add up. The 20% for a bi-weekly finance charge can end up being 520% interest if you look at it on an annual basis. So luckily in Virginia, they have regulated payday loans, and it's still high, but it's not as bad as this situation that can exist in some other states. It used to be that bad in Virginia, but they've really done a lot. They've done a favor to the consumers to regulate this, so consumers can't, in Virginia at least, can't get in that trap. There is a limit for a $500 loan per customer. You can only have one payday loan at a time, and they are required, the lender is required to check a database to make sure that you do not currently have one, or that you are not prevented from having one before they can offer you one. The term of the loan has to be at least twice as long as your pay cycle. So if you're paid bi-monthly, then the term of the loan has to be at least 1 month. The interest charge for Virginia is capped at 36% APR, so that's a lot better than what things in the past used to be. And a 20% loan fee and a $5 verification fee, which is probably the fee for checking that database. So as an example, if you borrow $300 for 1 month, you can be charged $9.30 of interest, a $60 loan fee, so 20% times the 300, and a $5 verification fee, so you're charged $74.30 fee in addition to repaying the $300. So Virginia payday loans cannot be rolled over. They have to be paid off before you can get another one. If you can't pay it, you have to work with the lender to see if they'll give you extended payment terms, or they can proceed to go legal means to get you to repay that unpaid debt. But they do have to wait in Virginia at least 60 days before they start taking you to court to repay that debt. Any complaints, if the payday lenders are not doing what they're supposed to, can be given to the Bureau of Financial Institutions. and in a written complaint, or I don't have the number, but I'm sure you can call them too to lodge any complaint. Second type of predatory lending is tax refund anticipation loans, which is a short-term cash advance against that anticipated tax refund. The APR on these, if you actually break it down for the amount of time that it takes for you to before you get that loan, is can be 60% to over 700%. Usually they charge about 10% of your anticipated refund. Unfortunately, these you walk out of your tax preparer's office with a check that day, but if they e-file, you'll usually get your refund within 5 to 10 days anyway. So you're not really having that money for a whole lot longer period of time than if you e-file. And over $1.5 billion were made by these tax preparers in these refund anticipation loan fees to get that better. A better option is utilizing VITA, Volunteer Income Tax Assistance Program, which is free, and they will e-file for you. I spent 1 year working for VITA through the military. Or AARP, Tax Aid Assistance. Some of the software programs, TurboTax or some programs are free if you have very simple taxes and you can e-file and do them yourself. And then request a direct deposit and you will get your refund very quickly. So that's a much better option than using some of those tax preparers and getting that refund anticipation loan. So as an example, let's say someone has a $13,000 income. First, they're going to pay a tax prep fee just to have a professional do their taxes, and lots of fees in here: a document preparation fee, transmitter fee, a bank fee, and then the $125 refund anticipation loan fee to get your money faster. On that small income, they've paid $357 in fees. And this is definitely a person who would qualify to have their taxes done for free at VITA or AARP. Okay, another type of predatory loan, car title loans. So you give the car lender or the lender your car title to get a loan. If you can't pay the loan back, your car is repossessed and you no longer have a car. The lender keeps the amount that the car sells for. So for an example, your car is worth $2,500. They're not going to give you a loan of $2,500. They're going to give you $1,000, maybe a third of what it's worth. And then if the car if you default on your agreement and they sell your car, they have $1,500 profit and you have no car. So the lenders will loan typically 25 to 35% of the car's value. These are again high interest rate products, so 20% or higher for 30-day loan, so which translates into a 240% APR. They usually require that you have a clear title, so a lot of the cars that they get tend to be older, but they're still good cars with lots of use on them. The lender takes a key as well, so they are all set. If you default, they'll go get your car. And this is a type of secured loan, so that puts your property, your vehicle at risk. And just a question, if you don't have the $500 today, do you really think you're going to have an extra $600 30 days from then to pay to get that vehicle back? So Virginia, again, just like the payday lenders, has some regulations to protect Virginians. There is a cap on the car interest rate at 22, 18, and 15% depending on the amount that you're borrowing. Of course, that still translates into huge APRs, between 180 and 264% APR, your annual percentage rate. You cannot have two car loans at the same time. Now, unfortunately, in Virginia, car title loans can be rolled over. But if it is rolled over, they have to register your title with the DMV. And there cannot be a location that makes both car title loans and payday loans in the same location. So another type of predatory lending is the rent-to-own contracts. Your merchandise that you get from them is rented. You pay the rent weekly or monthly until the item is owned. They don't disclose the interest rate, the overall interest rate that you're paying. And there's no limit to late fees charged if your payment is missed. If that happens, what you are renting can be repossessed. And a lot of the items that are rented by rent-to-own contracts are home electronics, furniture, computer equipment, appliances, jewelry, that sort of thing. So why do people do this? Because the weekly payments look really low. When you get into that contract, it looks very affordable. There's no down payment, there's no credit check, so and you can get the goods very quickly. You walk in, you walk out an hour later with the contract signed and your item that you want, or your item being delivered that afternoon. Options renting to own versus getting into a credit contract. The main difference is that the credit contracts are going to spell out, they're required to spell out the APR that you're paying and the payment terms. But they're going to be same thing with, you're making payments on it. Of course, with the rent to own, if you decide you don't want it anymore, you return the item and the contract is terminated. So a comparison of the costs. If let's start, actually I'm going to start at the bottom with a television that's a $250 TV cash sale. If you can make that purchase right then, your total cost for the TV is $250. On an installment sale, so let's say you charge it or you purchase it at some sort of agreement with the company to make partial payments on it, and if that's a 19% APR and you're paying $16 a month on it, for a year and a half, the total cost of the television is $291. And then your rent-to-own contract. $13 doesn't sound like very much a week to have that TV that you would like to have right now, but by the time you make payments for 6.5 years to own the television, you've paid over $1,000. And that doesn't include all of the fees that they put into the contract as well. So that's our base fee for the rental. They're going to add tax for each of those weeks. And you might agree to have optional coverage in case something happens to it, then you don't have to pay for the item. And then if it's a big item and you have to have it delivered, there's a delivery fee and a late fee if you miss a payment. And if it's picked up and then you have to have it re-delivered, a reinstatement fee and a re-delivery fee. And this $250 TV has cost you almost $1,200 by the time that you actually have it free and clear. So better options than going with the rent-to-own contract. Just delay gratification, save that $14 a week, and buy the TV outright once you've saved up the money for it. Purchasing it on some sort of a bank card or a store credit card, and your interest rate isn't anywhere close to, even if you just pay it off at $14 a week or $48 a month, it's going to be a lot less than this in the long run. Purchase a different item, buy it used, buy a make-do item until you can save up the money, or just ask yourself, do I really need this brand new item, or can I just make do with what I have? Next, pawn shops. You bring the item to be pawned at the shop. You get a ticket that describes the item and the money lent and the maturity date and all of those things with your item. A lot of things that are pawned, watches and jewelry, TVs, AV equipment, instruments, camera equipment, firearms. Loan defaults. If you don't pay back, what you have pawned becomes property of the pawn shop, usually after a grace period of 1 to 3 months. Most states require that they notify the customer that the item no longer belongs to them. The surplus after they sell it is supposed to be returned to the customer, but frequently it is not. And default rates range between 14 and 22%. People who pawn, get that money, think they'll get that, have the money to get that item back, and then can't. can be up to around 1 in 5 people don't end up getting their items back. So again, just like a lot of other types of loans, at first the cost seems low, but when taken as an APR, it can be as high as 240%. In addition, just like the payday loans, there are fees, there are storage fees, insurance fees that can be charged on top of the interest. The average loan is about $75 to $100, or 25 to 60% of the item's resale value. So next are check cashing outlets. These are mainly geared toward people who are unbanked and have to pay bills and have to send money. So they charge fees to cash checks. They might cash government, payroll, or personal checks, and depending on the type of check, they charge different amounts, different percentages to cash that check. So for an example, a $500 Social Security check, they might charge as much as $25 to cash that check. It can cost a family hundreds of dollars annually, and they might also be selling other high-cost financial products to these families. So we talked about they're charging interest. It can be between 1 and 20%, depending on the risk involved of the type of check. Obviously, a personal check written from someone else might be the riskiest to them, so that would be a high interest charge, typically between 2 and 6%. It's a huge growing financial services, because unfortunately a lot of families are unbanked and they still need to make financial transactions and pay bills. One study says the average annual cost to families is $396 to get 6 money orders per month. So a lot of fees for not being banked. Next, overdraft loans. This is a protection and a service to you offered by banks. This is a great source of revenue for banks. This is, of course, protection to the consumer in case you overdraw your account, either by a check that bounces, by trying to withdraw money out of an ATM, or using a debit card, or if you have an automatic transfer of funds out of your account to pay a bill. If you don't have sufficient funds, the bank is going to help you out so that your transaction doesn't bounce with the person you're trying to pay, or the transaction you're trying to finish at in a store. The bank will float you that money, but then they're going to charge you a fee, usually between $20 and $35 per transaction. And then they might also charge interest on the amount that they have loaned you until you make a deposit so that your so that your account is once again in a positive state. So if you go shopping and you have this type of protection on your account, and banks will usually clear your highest amount charged first and then the smaller fees. So let's say that you get a $4 coffee, and then you spend $15 at lunch, and then you make a $100 transaction at Walmart. The Walmart one, if you have $99 in your account, they'll try the Walmart one first, and you'll bounce because of $1, and they'll charge that $35 fee, and then of course the $15 one and the $4 one will bounce, and they'll charge you 2 more $35 fees for all of those transactions that bounce. So you've just paid $105 in fees because you were $15 short in your bank account. So it's sold as a customer service to help you not bounce checks and things, but actually it's a huge source of revenues for banks. It can be up to 10% of their revenue through these fees, and billions of dollars in fees collected by banks from these types of transactions. With your debit card, you have with your bank the option to opt in for this protection or opt out. You always want to opt out, unless you want to pay a lot of fees. There might be a little bit of embarrassment at the register of trying to slide your card or trying to get money out of an ATM and your transaction being declined. However, that's going to save you that $35 fee. So just an example, the banks can just as an overdraft protection, they can you can line up a line of credit loan to be associated with your account. Of course, that has interest, but even at 19% annual interest, that's a much better deal than overdraft protection loan that they'll give you, because the fee on that's $26. Your APR on that is $1,700, over $1,700. So huge difference in this. If it happens frequently that your account is overdrawn, you might want to arrange some sort of a protection so you're not hit by these fees, but in this case a line of credit loan is a much better option than that overdraft protection. Another predatory lender is sometimes for-profit trade schools. They might have a list of preferred lenders that they will refer you to, and those lenders will frequently give a kickback to the school, so it's a good revenue stream for the school. Some of those schools abuse federal student aid policies, and a lot of them don't keep promises. Sometimes only a small percentage of graduates actually are able to finish the programs, and a lot of time it's not the student's fault. The classes aren't offered, the program's closed, so the student is left with a whole lot of debt and no degree to show for it. A lot of times the students can't complete or pass exams, or they can't find jobs even if the school is promised up front to help. So the for-profit schools, you have to be very careful if you pursue a degree in that way. And there are publications online about a school's graduation rate. That would certainly be something to look at carefully before you decide to enroll in one of those schools. So as an alternative, look at nonprofit schools like a community college. Ask for a list of recent graduates to contact and get information about their experience in the program. Don't use the school's preferred lenders. Get financing for school on your own, and visit employers and ask employees where they went to school, places that you want to work. Mortgage lenders. This was obviously a huge problem about a decade ago, and luckily the regulations on this have been tightened, but I still see products out there that I consider predatory. Of course, the predatory mortgage lenders have higher interest rates, points, and fees. A lot of times they're offered by mortgage companies. They're looking almost for consumers who are at a greater credit risk. They're advertised as no credit, no problem, we'll lend to you. They're a much higher default rate, and I'm sure it's no surprise that in 2006, before the big mortgage crash, 20% of all mortgages were subprime. So what these mortgages encourage are frequent refinancing, a high debt service to income ratio, so that's the percentage that you are paying toward that mortgage depending on compared to the income that you have. That shouldn't be more than 30% for housing. So if your housing is costing you more than 30% of your income, that's not a situation you want to get into. A high loan to value ratio, so the value of the loan compared to the value of the property. Sometimes these lenders are going reverse redlining, so they're targeting minority populations and low-income populations. There might be loan packing, so on the big line of documents that you sign, there's lots of fees and unnecessary insurance products included in the documentation that they'll gloss over when reading through it with you. Prepayment penalties. No one should ever get into a loan where there's a prepayment penalty, where they charge you more money for paying it off early. That should always be encouraged. And then these days, especially with interest rates at almost record lows, no one should be getting into a loan that has a balloon payment or ARMs, so adjustable rate mortgages, because your base mortgage to get a fixed interest rate now is so low. There's no reason to get into these types of products where your interest rate can go up astronomically. or a balloon payment where you pay at a low interest rate for 5 to 7 years and then the whole balance of the loan is due. So thousands of dollars, hundreds of thousands of dollars possibly due all at one time. So these of course will have, let's see, sorry, that one. Okay, so all lenders, for all of the different types of predatory lending that we've talked about, avoid any lender who tells you to falsify information when you are filling out the application. Oh, go ahead, bump up, oh, you were laid off, well that's okay, I'm sure you'll get another job, just include the income that you had before. Pressure you to borrow more than you need. Oh, well, you're getting a loan, go ahead and get an extra $100. It's the holiday time, you might need it for something. Offer bigger loans than you can afford. So a lot of times that's your mortgage. This is your dream home. Go ahead. You'll make more money down the line. If they don't disclose all of the loan terms to you and explain the interest rates and all of the fees involved, if they tell you to sign blank forms, or they won't give you copies of things that you've signed. And finally, alternatives. If you need money, fast, what are ways to come up with it where you can avoid getting in these types of contracts? Go to a bank or a credit union and try to take out a small consumer loan. Contact the creditor that you owe money to and try to work out a payment plan with them. A lot of creditors, especially if you are on top of this and approach them when you're first getting in trouble, are very open to working with you, because it's a lot of work for them to go through a default process. They'd much rather work with you to make the payments reasonable so you can pay off your debt than have to go through that process. Ask your employer if it would be possible to get an advance. Utilize emergency assistance plans. That's what I actually work with. Or with military families, I work for a program that provides emergency financial assistance. Ours is targeted for military, but there are many other programs out there that provide assistance for utility bills and various other things. If you just look into it, a lot of times there's support there. Get an advance on a credit card. That's not ideal and the interest is high, but it's not hundreds of percentage points. So if you need cash quick, that can be a better alternative than getting in with some of the other types of lenders. And then again, we've talked about for taxes, utilize VITA or AARP, get your taxes done for free, wait that 5 days and then 5 to 10 days and you'll get that refund and you get to keep the whole thing. So, some key takeaways from that. Unfortunately, you can't borrow your way out of debt. Sometimes you have to make other arrangements or just wait like in rent-to-own contracts, just wait to have those types of things. Most reputable lenders are reputable and fair, but there are those out there who try to take advantage of consumers. Fees and interest rates are outrageous on these types of loan products that we've talked about today, and frequently the fees can exceed the amount that is borrowed. They target vulnerable customers, whether they just don't have a lot of information or confidence, and there are lots of other alternatives available to help families who might need that money. So, and always shop around when you're getting into a loan to try to get the best terms that you possibly can. And finally, as with everything, if something sounds too good to be true, it probably is. And I think that's everything for today. Any questions?
Yeah, have you seen the reports that that in-house car loans are going to be the next subprime, the next version of the bubble? Like what we saw with the mortgage crisis?
I'll say I've experienced that since my husband and I recently purchased a vehicle, and it was one that we had saved for, intended to pay cash for, but we weren't even on the lot when they were asking us how we intended to pay, we could talk to their financing guy, and it was absolutely very high pressure about the financing. They wanted to, they could make it work for us. And I see a lot of families falling into that. I work with a lot of military clients who are way upside down on car loans that they've gotten in that way from doing in-house financing, because they make they're talking about the payments and not the overall cost of the loan.
Right.
So frequently, when you make it, you can always work out a loan to make the payment affordable.
Right.
But then by the time you've had that loan for a couple of years, your car is upside down, and if something happens with it, you're really stuck. And that I work with a lot of families, so
Right.
I agree, and I'm hoping that I hope there'll be some looking at that situation and regulation on those interest rates and regulation on terms of loans, because now car loans used to be 3 years. Now the standard is kind of 5 years. Now they're getting stretched out to 8 years, and especially if you buy a new car, you are way upside down by the time you drive that thing off the lot. I mean, I can say personally, I've worked with families who are $20,000 upside down on a car loan.
Yeah.
And it breaks my heart. So yeah, that is a huge problem and something that people need to be very careful about.
It's another topic,
They need to have, the disclosure documents that they have in the mortgage industry, where that final HUD statement spells out exactly what you're paying and how much interest you're paying. I would really hope that if some families who get into these car loans saw what that car was going to actually cost them over the years that they had the term of the loan, they wouldn't do it.
So it's really another type of predatory
It
lending.
is, and that's next time I'll have to put that in here for next time doing this type of presentation, is something to be aware of, those types of car lenders.
It's like you said, it's emerging. Like
Yes.
it's one of those things that's kind of like just catching currency and attention in the way that the mortgage issue did 8 years ago.
Yes, and also, and probably just from my experience, I've probably at least 50% of the families who are seeking the emergency financial assistance are upside down on car loans, and
Really?
have a car payment, and the whole car transportation part of your budget shouldn't be more than 20% of your income. And sometimes between the car payment and then the insurance payment and the gas and everything else, I work with families, sometimes it's 50% of their income. And it's all wrapped around making one car affordable payment and then a second car affordable payment, and I see that being a huge problem for a lot of families that I work with. So I'm sure it's a huge problem just nationwide too for a lot of other families.
Can we talk just briefly about the morality of all this, and looking at, if you drawing other parallels in our society, you look at like the tobacco industry and the alcohol industry and the fast food and all that, and some people who are proponents of those industries would say that you need free will.
Yes.
Like you almost kind of like the existence of free will almost necessitates these temptations to exist. Is there a similar type of in your view, moral argument for predatory lending in this way? And maybe people are in very difficult ways teaching themselves lessons about patience and delayed gratification or that sort of thing. Or do we need to sort of like flip and go in a different direction in this? And I'm glad you included student loans, but even for legitimate educational institutions, student loans can be interpreted as
Yes.
predatory lending, especially targeting young people. Or does there come a point at which we as a society should get together and intervene and say that, this is not right and we don't have to have it. We don't have to stand for this. What are the moral solutions in your opinion?
That's an interesting question, and I might want to think about that too before spouting. But
Off the cuff.
It's difficult because I agree. People have free will; they get into these contracts themselves. But sometimes, as we talked about, it can be a vulnerable population who doesn't know a lot about what they're getting into, and maybe shame on them, but these lessons are huge. What they have to pay to learn this lesson is huge, and it can ruin their financial future for not just a month or two, but decades.
Right.
Some with the student, you talked about student loans. It's decades. It's a lifetime. It's somebody who who's 18 and doesn't know much and ends up borrowing $100,000 to get through college and then is working at a very, a rewarding but a very low, let's say education or social work, where you're not making a lot of money to pay those loans off. And, if you really thought about that, would you have, if you knew, would you get yourself into that situation if you had that type of an education? And the people selling a lot of these they're there to get their pay. There's, since the beginning of time, there have been people who are trying to get
Rich quick?
rich quick, get things from other people who aren't out for other people's best interest. And if it's not these products, it's going to be something else in the future. But I think I'm very appreciative of the legislation that has gone in over, especially over the payday loans. That was something that a lot of military families were just getting really sunk and stuck by, were those. So actually, I didn't talk about this in the presentation, but in Virginia, military families are not allowed to get payday loans. They're prohibited. So I think I appreciate the legislation.
So you support that?
I do, because there are there are people who are just really getting into these situations without a lot of thought by highly trained, high pressure people, predators going after them for these products, to that vulnerable young population without a lot of education in this field,
right.
And signing, and then it affects them for so long. I know that might not be everybody's viewpoint, but I do appreciate having that somebody looking out for those families.
Right.
Whether it be through legislation or something else, but I guess I do. I guess I am in favor of the Consumer Financial Protection Bureau trying to regulate and looking out for us, so that we know that this stuff is out there and can avoid it, so it doesn't ruin you financially.
Well, it's like you said in the past as well. Virginia has only recently legislated necessary financial literacy education in the public schools.
Yes.
So we have at least 1.5 to 2 generations where the financial system has become increasingly complex.
Yes.
But financial education has become increasingly absent. Even what my parents' generation had, the boomers had, in terms of home economics. That's something that came very much out of fashion and very much focused on just cooking, and not even the actual home economics element that used to exist in the curriculum. So you really have this kind of confluence of circumstances that make this type of predatory behavior prime, that make it infinitely more possible. And hopefully, as you've noted, with this movement toward financial literacy education, we'll see a reverse of the trend.
I hope so. And then maybe if all states have that education, and every student has gone through this type of training, then maybe it is a little bit more, you should have known better because you've had this experience. But unfortunately, like you said, a lot of kids moving into young adulthood didn't have that training, never got that, might not have had the best role models as parents to teach them about financial literacy, so just never really had a chance to know how to manage their money and resources well, and to not get into situations like working with predatory lenders. So hopefully, people will, with time, will be a little better educated, as every high school student will sit through a class very similar to this one, and know that this type of stuff is out there, and know to watch out for it. And then maybe they might not need something like Consumer Financial Protection Bureau watching over us so much, but
is predatory lending education part of the curriculum as it's been adopted?
I have not seen, but just from what I see included in
rubrics
in the curriculum for community college financial literacy, it is included. So I would think that it would be in there as well. But that's something I should check on. I've looked up the standards for that, and I haven't gone all the way through them to see that. But that's a good question. I'll have to look. Or next year I'll be able to ask my high schooler. He has to take it next year. So.
Yes. Well, I'm done.
All right.
I have, with the call title and the check cashing.
Yes.
Do you think the same people's running both? I know they can't be in the same building, but do you think the same group of people is running, both places? Because I noticed in Lynchburg, they they got a car title right here.
Mhm.
And directly across the street, they got a cash title or whatever you call it. And to me, they might be, the same people might be running both stores or whatever you call it.
I would say it's entirely possible, since they evidently, if there's a rule now that they can't be together, I would assume that there used to be a situation where they were together. So now they may have had to, not be in the same building, but it probably is the same company that's running both of them. So
'Cause I was
I
seeing
don't
that,
know for sure, but I would certainly bet that that would be the case. I mean, if they're into one business, why not be into the other? So.
Because, they could be making money on, the same group could be making money from two
Oh,
places.
absolutely, and I'm sure that's
For the
a
same
situation.
for the same given consumer,
Yeah,
you get your car loan, title loan here, and your payday advance here,
Yeah, you get your car title, a month goes by, you can't pay off, you need the money to pay off your car title, you don't have it, so they say, oh, just go over there and, get a loan with those people, and then they're, back and forth, so they pay the car off, they have the car, next month they can't pay off the payday loan, so they go, get the car title loan again, so yeah, that would be a very ugly cycle that...
And they're probably, where there's something ugly, there's someone ugly doing it.
Yeah, and it's just, it's very sad, but like we said, from the beginning of time, there've been people out to take other innocent people's money who, get into a situation because of, trust and innocence or lack of knowledge, and it's just unfortunate. So hopefully, like we were talking about with other education, that people will know better than to get into those types of situations. But it's sad. I'm sure we've all seen up at Centerville, there are no fewer than 10 pawn shops, payday lenders, check cashing, car title loans. I was shocked, because that had really grown up since we had not come to visit Halifax for about 3 years, and coming back and seeing how many more outlets there were than had been here when I had been visiting in the past. It was just really shocking how many are out there, and that they stay there, which means that there are people utilizing all of that. So, yeah, my husband suggested today that we move the presentation to like Centerville and right in front of some of those businesses right there. And I said, I don't know, we don't want to ruffle so many feathers we get arrested.
We can go out and film. We can do an expose. Go in and interview a person. Say, hey, what's it like to work here? And do you ever feel bad? Why not? Thank you, Mary. I know that this is a topic we've been talking about covering for over a year. So I'm so glad that we finally did it, and I think it's a very important message. I think you did an awesome job.
Oh, thank you. Well, I hope your viewers get something out of it and avoid getting in those types of situations. So.
Yep. All right. Thank you.